Folks, something that makes one rental at a time very different is we have these wonderful contributors who come back each week. And one of them we have today is Lance Lambert from Fortune. His great Twitter following is News Lambert. All things housing. How you doing, Lance?
Yeah, always a lot going on. Like you said, housing, housing, housing. And I think today we're talking seasonality, right?
Yeah, I think the first conversation, I'd love for you to just paint a vision about what normally happens as we kick off the summer heading into the end of the year, right? The spring selling season is behind us. So what's in front of us? Again, normal housing market. What's ahead of the
Yeah,
audience, you think?
a normal year starts out kind of strong and then starts to heat up into March, April, May, June. And those are the months that, at least in the indexes, get the highest readings for home price appreciation every year. So we've already seen, we've shifted from some of the small declines month over month last year nationally to now we're getting positive readings for home price growth. And we've now gotten for the Schiller February and March, but that also means the Schiller still has the bulk of the spring appreciation still to read. So we're still getting that. The Zillow is going to report May. And so that's going to come out on the 10th. So I think that might be Monday that's going to come out. And we'll start to see where we kind of topped out for home price appreciation nationally. But it looks like it's a pretty normal year. And so in a normal year, what happens is you have that uptick for appreciation, and then you start to have the slowing in the second half of the year. And usually on national price, you give up about like 0.5% in the second half of the year. And, of course, as inventory starts to build a little bit seasonally, although we're not seeing a lot of it this year, it's a very small increase in inventory. And to get more of that, you're going to need to see days on market kind of inch up more. But it's hard to get inventory to build when you've, one, had buyer acceptance at the higher mortgage rates, and two, we just don't have a lot of new listings coming on. So there's a huge constraint on the inventory build there. But in some of these markets, you're at that point of the season where buyers have kind of realized, oh, we've kind of priced it a little too high now. Some of them are starting to sit a little longer, and you have that seasonal rollover. That's normal. It's normal to have some seasonal slowing through the year. And then some people who don't get their price, they're going to delist and they're going to come back next spring. And next spring, it's going to be the same process over, assuming all else equal. There's no surprises, which there can be surprises, of course. Now that's nationally. And I think from nationally, there can be some different groupings here. Recently I was on the Bigger Pockets podcast, and I told them, if you ask me to find you a market or a zip code that I think is going to be down 5 for this year, I could do it. And if you wanted me to find a place that's going to be up 12% this year, despite going from 3 to 7% mortgage rates, I can find you these places. Rural Tennessee is like booming right now. And so I think in the second half of the year, some of these places in America that have boomed through the spring, it's possible they're going to break seasonality and stay hot in the second half of the year. And those places could get that 2020 effect where inventory doesn't really see a seasonal boost and just keeps going down. So that's a thing to watch out for. And another one that I'm interested in is specifically Phoenix and Vegas. They've really tightened up, right? They've tightened up this spring. Inventory still is going down. They haven't bottomed. Austin bottomed in January. So January was when we saw the frothy markets separate from each other. Austin has more of the supply overhang and some of the investor issues, and then Phoenix and Las Vegas just keep tightening and tightening. At some point, inventory needs to build in those places, or they could, the second half of the year might break seasonality and they keep getting tight. Like if let's play a scenario. If Phoenix and Las Vegas's inventory keeps declining July, August, September, that tells me they overcorrected last year. Like they corrected too far. If you come into the year and then you break seasonality on the other side, that's like an overcorrection. They went down too much. But we'll see. Maybe maybe inventory is about to build sooner than later. So that's one group that's interesting to me. Places that actually saw price declines last year, but are now still tightening and haven't bottomed for inventory. Those could be overcorrection markets. And then the other, of course, is Austin, which is the anomaly. There are 400 markets in the country tracked, the 400 largest tracked by the Zillow Home Value Index. Only 2 are down by 10% or more on a seasonally adjusted basis. One of those is San Francisco, the other is Austin. So seeing what happens to Austin in the second half of the year, given that inventory peaked in January and is building, and they're going to next month or the month after, they're going to top their high from last year for inventory. Ooh. Let's see what happens to them now as seasonality works against them. So a lot of different stories out there, but I would say that just because you start to see markets slow doesn't necessarily mean it's going to be second half of 2022, which is a mortgage rate shock. Remember, this month is a year since we had 6%. So the shock, we've gotten past the shock phase. And so seasonal slowing, but don't jump right to correction.
Yeah, I think there's a couple of things, and I'm glad that we went to price first, because as you know, in housing and certainly in social media, price, right? Crash, correction. That's where everybody goes. I'm trying to help people understand, if you're really in this game, certainly as an investor, and I would argue a homeowner, I wouldn't over-rotate to price. I would actually go to inventory. And then more importantly, for me, it's new listings. Yeah. Right? In most markets, in most buy boxes that I talk about, new listings are down 20 to 30% from last year. And yes, days on market are growing, but that's because older inventory is there. Maybe you have, overpriced stuff. Who knows? You have bifurcated market below the median, above the median. There's just a lot going on there. So historically speaking, like 2019 before, inventory generally builds kind of July through November, generally speaking. Is that fair?
Before the pandemic?
Yeah.
So new listings start moving up January through like June, right? And then around March, February, inventory starts to move up. Or maybe new listings start in like December. It's like a few month difference.
It's a lag. Makes sense. Okay.
And then inventory continues to build for a few months after new listings go down, because there's a cyclical move up in days on market is what happens. So inventory is the in-between new listings and days on market.
Exactly. So again, one of the things I would tell people to watch if you're in your buy box and you're doing your daily discipline, just note new listings that hit your buy box. I have a sneaky suspicion that those may continue to disappoint, and we will have continual 20%, down year on year in new listings. We'll see. Eventually, we're going to start lapping these numbers. Like you talked about interest rates. We're about a year away from the first time we hit 6%. And I think within about 6 weeks, it might be 8 weeks, Lance, there's a very good chance that we have negative year-on-year mortgage rates, right? We were at 7% like early August, late July. We're going to have, we could very easily have negative year-on-year mortgage rates in 8 weeks.
Well, and even today, it's within 1%.
Yeah.
Now, next month, technically, it's like going to be 1.5% if we kind of stay here, because last year it ran up in June and then kind of fell back a bit for July and August, and then had, a big run up. And the interesting thing about the shock last year is that the big jump, an important thing is that we went into the spring 2022 market without mortgage rates up, right? And inventory was all the way down at like a stupid level. So that helped to boost appreciation to an insane level.
Unhealthy level.
Yeah. And having appreciation for the year go over its skis a bit. And then in the second half of the year to have the shock and the seasonally slow period, that's what created corrections in some markets. If you would take the mortgage rates and you would put them up 6 months earlier and then not have the peak be at the bottom of the seasonal period, like if the timeline was just moved 6 months, we probably don't see a lot of what we saw in the second half of the year. But at the same time, prices are probably still right around here. right? Like
Exactly.
we probably need at the same point anyway.
Yeah, we just had a little bit of run up. We gave it back because yeah. So it's really interesting to watch. So again, folks, I know people orient towards price. If you are really looking for a home, watch new listings, watch inventory, because again, I think interest rate. My call, not yours. You don't make prediction. Is I think we've seen the year peak. I think it was 7 point whatever it was, 18, 12, whatever it was, and we're going to go down from here. We got the debt ceiling. We just got softer or stronger unemployment claims today. I think we're going to get
if we got a mortgage rate reading for today. I haven't checked yet.
And then on Tuesday, I think we're going to get a CPI headline that's 4.3 or better. So I expect rates to be noticeably better next week. My call, not yours. What did we get a posting today?
No, not yet. It's going to go down for the day though. It will probably go under 6.9 for the day.
Yeah. There we go. So again, this is very interesting time to watch. I think it's going to be interesting because if supply doesn't come and we have rates get better or lower, depending on your opinion, what's going to happen is we get to the end of the year. Because unlike last time where rates went up into the slow period, now if we have rates trick down into the slow period, it'll be interesting to watch. What do you think?
Yeah, and I think the most important is, well, I think that part's important because if rates move down, I don't necessarily, I mean, the chances of it booming in the second half of the year, I don't know. But what it could do is the dynamic setup for next spring, it could then reduce, even if new listings go up, if mortgage rates go down, it could still reduce active listings as more buyers come into the market. So if that happens in the second half of the year, and then next year we enter the year and we have a sub 6% mortgage rate, and inventory is not in a good spot, we can kind of see what.
Yeah, we know what happened last time that happened, when rates were down and supply was negligible in the spring selling season.
And that is a scenario where all things else being equal, and we don't have this financial system tremor or something like that.
Yeah, exactly. But folks, again, watch new listings, watch inventory, watch days on market. Price is an interesting social media talking point, but I think you'll get a lot more detail if you're truly shopping by looking at the other metrics. Lance, where can people follow you? Because you put out a lot of amazing stuff.
Yeah, they can find me at News Lambert or Google Lance Lambert Fortune, and you'll find all my stories. And then the third place is here every Thursday.
I appreciate you, man. Thank you for coming back.